Hey guys, Boris Lasser from BKT. Good to be with you again. This week I want to show you something a little different, but at the same time also extremely dangerous. So if you're going to follow some of these rules, always use a stop in this particular strategy, because unlike any other strategy that I've shown you, this is the one that will guarantee to blow you out if you do not control risk in this particular strategy. What I want to discuss this week is the idea of martingaling. Martingaling is basically the idea of adding to a position when price goes against you so that you can recover your profits much quicker. It's a very seductive strategy, but it generally almost never works the way it's supposed to, because what happens is there are times when price simply moves too much in one direction and you blow out your account. So one of the things that I kind of want to discuss today was how we could modify the martingale strategy and basically trade like market makers. What do market makers do? Market makers basically always fade the move, because market makers' job is to provide liquidity. And liquidity basically means everybody demanding price in one direction. So if prices are going up, market makers are selling, and if prices are going down, market makers are buying. Generally, that actually tends to be a relatively positive expectancy strategy, because what happens is price never goes in one direction, it always has a correction, and during these corrections when market makers make back their money. However, it can be a very dangerous strategy to apply without any kind of risk control. The standard martingale strategy basically says sell here, if it goes up sell more, if it goes up sell more, and then eventually it'll turn around and you'll be able to recoup all your losses very quickly. That is not what I'm going to suggest we try and do here. I want to show you a variation on the martingale strategy that I think has the advantage of some of the statistical reasons for why it works versus some of the disadvantage of basically blowing up your account if it doesn't go your way. Now, the basic theory behind martingale is the following. Everybody knows statistically that when we're playing heads or tails, every single flip of the coin is independent, and the thing that you've always been taught is that every single flip of the coin is a 50-50 proposition, that it doesn't matter what happened before, every single flip is going to be a 50-50 proposition. Well, yes, that's very true, but it's actually the wrong question to ask, because the more interesting question to ask is, what's the probability of heads occurring 3 times in a row? And that probability actually is much lower than 50-50. It's 1.5 times 1.5 times 1.5. It basically is 12%. And that is really the foundational statistical theory behind martingale. The idea here isn't that something is going to have a high probability of turning back. It's that something is going to have a high probability of retracing if you have a continuation in one direction. So to put it into trading terms, the probability of an up candle being followed by a down candle is 50-50. But the probability of 3 up candles being followed by a down candle is considerably better than 50-50. That's this martingale edge that everybody tries to exploit. And generally, it tends to work in your favor, with the exception of times when you have just basic continuity in one direction or the other. So I wanted to show you an idea of how we trade martingale with a twist. Basically, here's my martingale strategy with modified stops. What I try and do is the following. Let's assume that we have a burst up to the 3 standard deviation and we're going to fade this move. We're going to fade it with a 10-point stop and a 10-point target. So we fade this move and it moves against us. We wait. This is very important. We get stopped out. We get stopped out -10. And now, instead of just simply jumping right back into price, we wait until the candle completes in order to make sure that price hasn't fully extended. Here's an example of why we do this. Let's assume I got stopped out on this at -10, and this particular candle didn't just simply go 3 or 4 points higher, but went up 100 points more. Something extraordinary happened in the market. If I just jumped right back into the price, I would have continuously been losing money. On the other hand, if I let the candle complete and it's a big move of 100 points, I've skipped all of this move and I can short pretty much at the high of that particular candle and have a greater probability of a retrace. So we get stopped out, we double up our position, and we try to find the retrace. And in this particular case, obviously, 10-point retrace gives us a 10-point profit. We're -10 here, +20 here, that gives us a profit. How many times do I do this? I do this no more than 4 times, meaning that I will do a particular trade segment once, twice, 3 times, and absolute final time, the 4 times. If you are getting stopped out 4 continuous times on a particular trade segment, something is going wrong in that particular trade. The intensity of demand in one direction is so strong that it's much better to simply walk away. Now granted, this is a very, very dangerous strategy, and it's actually very massively destructive to your equity at that point. It's another reason for you to really want to walk away, because if you do not stop at -4, you pretty much face the risk of ruin very quickly. And then you have to regroup, and you have to start again with 1 unit, 2 units, 3 units, 4 units if you have to go, and rebuild your equity slowly. So this is a kind of a strategy that sort of requires, gives you continuous positive expectations for a long time, and then has a massive drawdown, and then you have to rebuild it. And you have to have both the mental and the physical stamina to stay with this kind of a strategy. I want to show you, so this is basically a 5-minute chart. I have to go back to the 15-minute chart to show you the demarcations of the strategy, only because I did this during the middle of the week. I didn't get a chance to do it at the end of the week, and Oenda doesn't go back. So you can see that, for example, that here's an example. This is a 15-minute chart, but assume this is a 5-minute chart, and I'm basically buying on the lower Bollinger Band. I got my ass handed to me on a downward move that simply just did not stop. It was sort of like the kind of situation that you see here, where you just kind of drip down, drip down, drip down. Every move up was a fake out. Every move up was a fake out for 3 or 4 times. But finally, on the 4th segment, it actually turned positive, and I was able to recoup my losses, and then I was able to successfully trade the downside. This was 5-minute sell downs on the strategy. And the net result that I want to show you is that the equity looks something like this. You have a very, very sharp drawdown when you're just constantly basically absorbing losses, losses, losses. And then, if you stick with the strategy, you have a very quick recoup rate. And by the end of it, I was able to basically break myself to even. So next week, I'm going to trade this full force every single day. And we're going to see just how well the equity strategy does over a longer term period of time. But again, there are 2 things I warn you about this strategy. Number 1, you must absolutely use intra-strategy stops. That is, every single segment, if it stops you out, you must get out. And you must stop the strategy on any particular trade position after 4 tries if you want to be able to preserve your equity to fight another day. So this is Boris Schlossberg. I'm wishing you the best of luck. We're going to martingale like market makers next week, and I hope to talk to you then. Over and out.